Okay, Assalamualaikum warahmatullahi wabarakatuh and good afternoon. In this class, we're going to do a revision on accounting for property, plant and equipment. I'm going to do I'm going to discuss one question. I will let every one of you to try the question first, maybe for 15 minutes, and then I'm going to discuss the answer, the strategy, how to solve the questions. You did try several questions on this topic during tutorial. So I hope you'll be able to solve this question easily. This question come from the textbook Loftus, yeah. Question 5.12, I think you did question 5.11 and 5.17. Okay, let me read the question for all of you. Okay. Oops, sorry. So on 3rd June 2022, the statement of financial position of Kukabura Limited showed the following non-current assets after charging depreciations. Okay, so this is the financial statement after charging depreciations. Okay, we have two types of assets. First is building. The cost is 600,000. The accumulated depreciation is 200,000. So the carrying amount is 400,000. For the second type of asset is motor vehicles. The cost is 240,000. The accumulated depreciation is 80,000. That brings us to a carrying amount of 160,000. Kukabura Limited, yeah, adopted the fair value for valuation of non-current assets. They opt for revaluation method. This has resulted in the recognition of previous period of asset revaluation surplus for building. For building, we have asset revaluation surplus of 28,000. It means that previously, maybe in 2021 or 2020, we did revaluation outwards, which cause us, which result in asset revaluation surplus (ARS) of 28,000. On 30th June 2020, an independent valuer assessed the fair value of the building and found that the fair value of the building should only be 320,000, 320. While for vehicles, the value should be 180. So you need to compare your carrying amount, 400,000, with 320,000. So there is a difference of 80,000, yeah, from your carrying amount and the fair value based on the independent valuer valuations for building. For motor vehicles, in contrast, you find that the carrying amount is much lower than the value assessed by the independent valuer. Your carrying amount is 160,000, whereas the fair value of the motor vehicle is 180,000. So this is very simple question. You should be able to solve this question within between 5 to 10 minutes. You are required to prepare and then any necessary entries to revalue the building and the vehicle as at 30th June 2022. Okay. And then always remember to do revaluation, you have three steps. You have 3 steps. Okay. You need to remember the 3 steps. Assume that the building and vehicle had remaining useful life. That is on 30th June 2022, the remaining useful life is 25 years for building, while for motor vehicle is 4 years with zero residual value. So it's going to be easy because zero residual value. So you are required to calculate the new depreciation value for the year ended June 2023, mean next year. I'm talking about next year, yeah? Mean completion of 1 year cycle using the straight line method. So I'm giving you 15 minutes to try to solve part 1 and part 2, and I'm going to discuss the answer afterwards. Okay? Hello, welcome back. Yeah, I've given you 10 minutes to try these questions. Okay, let us go and see what are our strategy to solve this question. So what you need to do is you should go from one type of assets to another type of assets. Okay, so always remember that we have, in order to do adjustment for revaluation, there are 3 steps. Number one is we're going to offset. Yeah, we're going to close our accumulated depreciation accounts. Number two, we're going to record the gain or loss on the valuation. And finally, we're going to transfer the other comprehensive income, gain on other comprehensive income from other comprehensive income to asset revaluation surplus. So these are the 3 steps. Yeah, always remember that we have 3 steps. Don't miss any step of it. Let's start with step number 1. You need to close this accumulated. Let us do for building first. For building, the accumulated depreciation to date is 200,000. This is very easy questions because you were given the accumulated depreciation, yeah, on the date of revaluations. So if I want to come up with more difficult questions, I will have a different value for accumulated depreciation, where you have to determine what is the accumulated depreciation to date. So your first task, you're going to close this account. This will be your first task. And then your second task is you're going to compare your carrying amount. This is your CA with the new fair value, okay, for building, the new value for building, that is 320,000. So if you look at this example, you will notice that we have a loss, yeah, loss on revaluation, okay. The amount is 80,000. The amount is 80,000. But be careful, because previously in the question it stated that in the previous year we have asset revaluation surplus for building 28,000. So we have element of reversal here, reversals, yeah, reversal. So how we're going to do that is very easy. This is step number 1, and then we need to record the loss. Okay, if we have this reversal, we're going to offset with our other comprehensive income, and later on we are going to put it in our profit and loss. Yeah, if the value fall below the reversal value, then the difference will go straight away to profit and loss account. Yeah, so we have 2 types of losses now. Okay, let me show you the answer. But the first one is very easy. Debit accumulated depreciation, credit building. Debit accumulated depreciation, credit building. For the second one, we have 80,000 losses. So this 80,000, a portion is a reversal. This is 28,000. Okay, and then we have our current year. The amount is 52,000. So this will go to profit and loss. This will go to our other comprehensive income. Okay, and finally, we're going to do a reversal or adjustment on our reversal account, asset revaluation surplus. We're going to close our asset revaluation surplus account. So this is step number 3, that we're going to close our asset revaluation surplus by offsetting with the loss on reversal in our other comprehensive income. Okay, The answer will be something like this. First, you're going to record this is step number one. Step number one, I'm writing down to the carrying amount, debit accumulated depreciation, credit building by 200,000. Okay. Step number two, I'm going to record the loss. As I mentioned before, we have two types of losses. The first one is the reversal on the previous income, on the previous asset version surplus. So we're going to reverse maximum of 28,000. So this goes under other comprehensive income. The loss on devaluation go under other comprehensive income, 28,000, and the balance will straight away go to your profit and loss, current year profit. Yeah, we're going to charge our current year profit by 52,000. 52,000. Okay, and then we're going to credit our building by 80,000. So previously, our building, this is our building account. Still remember? Okay, we have 600,000. We have 600,000. This is the value. Then we close our accumulated depreciation by 200,000. Now I'm going to deduct another 80,000. So the carry down value, the balance carry down value for this building is only 320,000. So this is the second step. And finally, this loss on the valuation from other comprehensive income, I'm going to reduce my asset revaluation surplus of 28,000. So this is step number 3. Asset revaluation surplus, debit, mean I'm closing the asset revaluation surplus by 28,000. And then I'm going to debit my loss on the valuations. There is other comprehensive income, credit 28,000. So I'm closing the OCI part there. So this is the 3-step relating to building. We did discuss about loss on revaluation. You still remember there's a graph here stating about the value there, and then what are the value down here. So this is reversal, we call as reversal. This element should go to P&L, and this element should go to OCI, other comprehensive income section. Okay, that is for building. I believe you will not have any problem to answer that questions. Let us go to the vehicles. Yeah, vehicle is slightly different because our carrying amount in this question is 160,000. So this is the carrying amount. Our CA is 160,000, whereas the value of this vehicle is 180,000. So in this case, we have gain. How much is our gain? Gain of 20,000. So what are the steps? It's very easy. As I mentioned before, we have the 3 steps calculating to do adjustment for the valuation of asset. Same goes for the gain. Okay, let us look at the carrying amount, 160,000. The accumulated depreciation is 80,000. So I'm going to close this offset or close this amount, write off this amount from our motor vehicles accounts. So how I'm going to do that? Very easy. I'm going to close my accumulated depreciation vehicle account. I'm going to debit 80,000, and I'm going to credit my vehicle 80,000. So previously we have 240. Still remember we have 240 here. Sorry. Okay, this is my vehicle account. Let me just draw it here. This is my vehicle account. I have 240,000. This is the cost. I'm offsetting 80,000. This comes from accumulated depreciation, and the balance CD now is 160,000. But based on the valuation, we found that there is increase in value of vehicles. So I need to add another 20,000. So I'm debiting 20,000 from my vehicle account. So my value of vehicle now increase. Instead of 160, now is 100 and no, I'm debiting. Sorry about that. I'm debiting my vehicle account. So because of that, my value of vehicle increase. So debit vehicle 20,000, and the increase will go under gain on revaluation based on vehicle in your other comprehensive income, yeah, statement, other comprehensive income. So we're going to credit other comprehensive income. This is step number one. This is your step number two. And then step number three, we are going to offset these OCI accounts and transfer that profit to a reserve. We call it as ARS, asset revaluation surplus, by 20,000. By 20,000. So this is the three steps. Yeah, it's opposite of what we have done before. This is very easy. Please compare the carrying amount with the fair value of the assets, and then we will be able to determine whether you're making gain or loss on revaluation. So in this case, 160 you already add by 20,000, so the new value should be 180,000. So this is the new value for vehicles, whereas for building the new value is only 320,000. Okay. 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 And then the next part will be depreciation. The question asks you to prepare the journal entry to calculate depreciation. It's very easy. Yeah. It states here that the building has a remaining useful life of 25 years, whereas for vehicle is 4 years, zero residual value, and you are using straight line method. So it's very easy. So what is the value of building right now? After 1 year, this is after 1 year. What is the value of building now? 320,000. Okay. And then you're going to divide by 25 years. So this gives you your annual depreciation. Annual depreciation for building. Whereas for vehicle, it's very straightforward. For vehicles, yeah, the value is 180,000, and the estimated useful life is 4 years. So from here, you're going to get annual depreciation for vehicles, that is 45,000 here. 45,000. Okay. So what are the journal entries? Debit depreciation expense for the current year. You go to the profit and loss, and credit accumulated depreciation, that which go to your statement of financial position. So this is the answer. Debit depreciation expense for building 12,800, or equal to 320,000, divided by 25 years, and credit accumulated depreciation 12,800. For vehicles, it's very easy. Same general entries. Debit depreciation expense 45,000, and credit accumulated depreciation by 45,000. So I hope this gives you some basic idea on how to do revaluation outward and revaluation downward. Thank you so much for attending and watching the video.